Hey, this is Brad Block, host of The Physician's Guide to Doctoring. This is a personal and professional development podcast for physicians where we have experts on the show that try to teach us everything we should have been learning while we were memorizing Krebs cycle. Doctors change lives every day, but what happens when life changes yours? A single injury, a sudden illness, your career, your income, your future can shift in an instant. The best physicians don't just plan for success, they protect it. At Set for Life Insurance, they believe financial security isn't a luxury, it's a necessity. True own occupation disability insurance ensures that no matter what happens, your future stays in your hands. Because protecting your income means protecting everything you've built. Visit drpodcastnetwork.co/setforlife today. Secure your future before life makes that choice for you. Welcome back to the podcast. Does it ever keep you up at night that you might have an injury or illness that prevents you from working and that could potentially lead to a financial calamity for you and your family? If it doesn't, it should. And we're going to be talking about what you can do to make sure you can sleep at night, knowing that your family and yourself will be financially secure if something like that happens. So on today's episode, we have Jamie Fleischner. She's the founder and president of Set for Life Insurance, a leading firm specializing in disability and life insurance for physicians. With over 30 years of experience, she's worked with thousands of residents and attending physicians, helping them navigate the complexities of protecting their income and securing their financial future. Set for Life offers exclusive discounts and guaranteed standard issue policies specifically for medical residents. And if you're not sure what that is, go back to my last interview with Jamie where we really cover that in great detail. She makes it easier for young doctors to obtain high quality coverage without medical underwriting. But that's not what we're going to be talking about today. We're going to be talking about the not so young doctors who are like, do I have the right amount of coverage for where I am now in my life and my career? Jamie's going to be answering those questions. And just to be clear, this is a sponsored episode. So thank you, Jamie Fleischner, for supporting the podcast and the network.
Thanks for having me.
My first question is, how often should we be reassessing our coverage to see if we're under or even overinsured? It's possibly to be overinsured if you're like financially free or close to it. You want to make sure you have the right amount of coverage. So how often should we be reassessing?
There's pretty much three phases in a physician's sort of financial life when it comes to disability insurance. The first phase is in residency coming out of training, and that's when most people initially get their policies and they're well informed about it. They get the discounts, they're really excited, and then they go off into their careers. And oftentimes they don't ever revisit this. They get it and forget about it. And that can be a problem, as you mentioned. So the first part is the residence. The second tier part is really that mid-range. You're just going through your career. You're in your 30s, 40s. Things are stable in your career. And then there's the later part of your career when you're getting ready to phase out, maybe in your 50s or 60s, retirement is on the horizon. So those are the three major blocks, if you will. But it's really important in each stage to reassess what your needs are. So the typical path is you get your policy in residency. A few years later, maybe you make a partner, you have a bump in income, and you increase your policy. And then again, most people don't revisit it. I personally think it's really important to look at the policy at least every 3 years, just to check in, see where things are, just to make sure everything is in order. Because anytime you have any kind of major life event, that is also the time that you really need to revisit your insurance. So if you buy a house, if you move, if you change jobs, if you get married, if you get divorced, if you have kids, any kind of major life event like that will impact your financial situation. And anything that impacts your financial situation needs to be readdressed with your disability insurance, because disability insurance insures the whole foundation of your financial situation. So if you get your policy during residency, you get it and forget it. And then you go off, you get married, you have a mortgage, and you make partner, you've taken on all these expenses, you have a couple of kids, and all of a sudden you get into an accident or you're diagnosed with something, if you haven't revisited that insurance, chances are you're not adequately insured. So those are the times that you really need to reassess.
Okay. That makes a whole lot of sense. It's not like it needs to be at some regular cadence so much that it does need to be a significant change in your financial situation, whether it's changing jobs, change to your family status, anything like that. For instance, the kids are out of the house, right? The kids go away to college. It might be that you're paying for college, but now they're finally off the rolls and you're not paying for them anymore. Now you're in a different financial situation. So
yes, I'm working
different
with a lot of people. I'm 30 years in now, and I'm working with a lot of clients that are now in that phase. They're in their 50s. The house is paid off. The kids are out of the house, and they just say, I just need to get to the finish line. I just need the next 5 to 10 years until I'm completely financially independent and I'm ready to be done. And in those circumstances, we also readdress the insurance and say, maybe you're overinsured, like you said. Maybe you peaked when you had everybody at home and you had the mortgage and all of these extra expenses, but maybe now your student loans are paid off, your house is paid off, college is paid for. Maybe you just need to get those next couple of years until you've really finalized retirement. And that's the time where we look at your policy and say, maybe we don't need a cost of living rider on the policy. Maybe you can get by with less benefit. Maybe you can have a longer waiting period. And by trimming the policy, you're also reducing the premium, which is therefore reducing your expenses. Once you're at a point where you're completely financially independent, where you can rely on all your own assets, that's the point where you don't need your disability insurance anymore.
Yeah. You're effectively self-insured at that point. You get insurance for what you can't afford if it breaks, right? That's
exactly. And that goes for life insurance too. So the goal for life insurance, again, you have young kids, you need say $3 million of life insurance. You really need it until you've either accumulated that 3 million or until your kids are hopefully up and out. And so you get to a point where you can wean yourself off, where you have enough to sustain that loss if something happens.
So you mentioned life insurance, and I just want to give a quick shout out to Coben Solberg, who is my financial advisor, who is advising us to get life insurance for my wife, which neither of us had considered. So I do want to take this segue to talk about that for a little while before we circle back to disability again, because it's something that neither my wife nor I had thought about, right? Like, I'm the breadwinner. She has some side gigs, like she manages our short-term rental property. She's got a cooking business. She does earn income, but like the lion's share of the money comes from my income. And so we never thought that she would need life insurance. And he's like, what if something happens to her? How much are you going to need to pay in order to replace all that she does financially? And so let's talk about that for a little while, because it's something that we've never considered. And I don't know how to calculate like the hidden
so
financial
I think what you need to do is
of her work.
So I think you have to look at your overall budget and you say, okay, our overall budget, we need X amount per month to live on and to save and to et cetera. If something happens to you, obviously you need to replace that need. You're the breadwinner, but you have to just look at it economically. If something happens to her, are you still able to cover all of those expenses with your income? And if the answer is yes, then you may not need to have the insurance on her. It's going to be tight.
She does. No. So it's not that. It's not that her income is going to need to be replaced, because it won't. It's what she does that now I'm going to need.
But yeah, so if you need to hire childcare, if you need to hire somebody to drive the kids to their activities, if you need to have somebody taking care of all of those types of things do have economic value as well. Yeah. So that's where you need to calculate how much would it cost to hire somebody to replace.
Exactly. So I don't even know where to begin on how to do that. So if I was to approach you and say, I need to get life insurance for her, like, how much do I need? How do I make that? How do I know what needs to get included in that cost to make sure I'm not?
So when I look at life insurance, yes. So sometimes it's easier to look at life insurance on a monthly basis than a large number, because sometimes those large numbers don't make any sense. $1 million, $2 million. So you want to look on a monthly basis. So each $1 million of life insurance brings the household about $4,000 a month. If something happened to her, I need about $3,000, $4,000 a month to be able to hire somebody for some childcare that has a little bit of extra to maybe I don't want to work as much. It'll relieve some of the pressure, et cetera. If you need $4,000 a month benefit, you probably need about $1 million. If you say I only need $2,000, you need a $500,000 policy. That's how I calculate that on a month-to-month basis. And the answer is it depends on your household, depends on what your needs are. You've got 3 kids, they're young. Your needs are going to be different than your colleague who maybe has 1 teenager in high school. You know what I mean? So it really depends on your own personal situation.
And it sounds like you're not just going to have to calculate the work that they do, but there needs to be an underlying assumption there, especially if there are small kids at home, that you will inevitably need to work less because there are some things that can't be replaced by someone else doing the work. And so you need to take into account the fact that you will be working less because there are times that only a parent can. Okay. So it sounds like
you're going to want to attend the back to school nights. You're going to want to do the teacher conferences and you might need to be around more if you're the only parent. So those are all definitely considerations.
Yeah. And if there's more family support in the area, maybe you won't need to do that as much. Maybe there are some grandparents who are involved, but not everyone has that. Okay. So that's a lot to think about when coming up with that calculation. Okay. So it's $1 million policy, amounts to around $4,000 a month. So does that mean, I'm not sure if this math works out, $500,000 policy is $2,000 a month?
Exactly. That's pretty. And again, I would have it because on a term policy, you can choose the length of the term. I usually say you want it in force until the youngest kid is about age 25. That's about the time when they're hopefully off the payroll, up and out. So if your youngest kid is 5 years old, you'd probably be okay with a 20-year term.
Right. But we're not talking about me because we're talking about the spouse who's not a breadwinner or who might be significantly less of a breadwinner. You can probably end that policy when the kids are out of the house.
You could probably do a 15-year till they're up and out. Yeah.
Okay. That makes sense. Hey there, it's Brad. As someone who's passionate about podcasting, I've always thought there should be more support for physicians who want to share their stories and expertise. That's why we're launching Doctor Podcast Network.
We're bringing together a community of physician podcasters with one goal in mind: to provide the tools, connections, and resources you need to grow your show. So whether you've been podcasting for a while or maybe you're just starting, we've designed this network to support you every step of the way, and we're going to help each other rise, not compete.
If this sounds like something you'd benefit from, we'd love for you to join us as we get closer to launch. So you can sign up at drpodcastnetwork.co for early access. Stay tuned for more details in the coming weeks. Really looking forward to what we can create together. Doctor Podcast Network, where doctors podcast.
Doctor Podcast Network, where doctors podcast.
Doctor Podcast Network, where doctors podcast.
Okay, so let's go back to disability because that's my main concern here. Because for the mid-career physician who's really assessed their needs, and let's say they didn't take advantage, this hypothetical person who happens to look and sound and smell like me, didn't get much of a policy or like barely any policy when they were a resident because they were ill-advised by family members about disability insurance. And now they've hit mid-career and they've done a bunch of podcast interviews or listened to a bunch of podcasts and realize that all they have is this group policy. And what are the factors for a mid-career physician who's then realizing that they need to get disability insurance?
So the first thing is it's probably important to be aware of what a group policy offers. And if you're part of a hospital or a large group, chances are you probably have a group disability policy. And typically you're required to sign up for it because they have to have a certain level of participation. Some group policies allow you to opt out. Most of them don't. So if you're part of this group, chances are, again, you have this group policy. Yeah. Now, because the group doesn't ask medical questions, they have no control over the risk. So they don't know who they're getting. So as a result, it's just more of a generic type of policy that they offer for everybody. Yeah. So what most group policies say is if you're totally disabled, they're going to give you 60% of your income, and it usually caps out at $10,000 a month or $15,000 a month. If the employer is paying the premiums, that amount is also taxable. So group policies are typically more intended for the rank and file employees and less so for the physicians. So the larger your income, the less coverage you actually have. So if you're making $300, $400, $500,000 and your policy caps out at $10,000 a month and that's taxable, the net effect is you're only going to get $7,000 a month or approximately, because it's going to be taxable.
Okay. So that wouldn't be the
that
case
leaves
if
a
it's like
big
a
gap.
physician group,
Yeah.
right? Like what you're assuming is like you're part of a large hospital system where they're also providing disability insurance for the maintenance workers. That's not assumed for a physician group. So if you've got a
because
large
there's going to be a
physician group-
cap. So the larger
Yeah.
the income, the less replacement you're going to get. So that's one of the things to keep in mind. Number two, most group policies require you to be totally disabled and not working. So if something happens and you're a physician, let's say something happens to you and you hurt your back really badly and you can't go into work, but you're still able to podcast, they might say, hey, you're working, you're earning income, we don't have to pay your claim. So most of them say you have to be totally disabled and not working. So it's a more
Is there any way to
strict definition.
reclassify this as a nonprofit so that they aren't able to consider this part of my income?
I don't know. So again, it's really more of a taxability issue. So again, they're paying the premiums, the benefits are taxable to you. And there's really no way to get around it. Some small groups will actually allow people they'll buy their own policy, or they can pay up, or they'll bonus you and you can go and buy your own insurance. There are some circumstances. Some large groups, they actually say, we'll only give you 50%. If you want to buy some additional through the group, you can do. And again, if you're paying that premium, that part of it is non-taxable. But again, most group policies are really generic. A couple of other things to be aware of is if you ever leave your group, that policy doesn't go with you. It's not portable. So
Not
the
like a
problem
plan.
becomes if you leave that group, and let's say you go to a smaller practice where they don't have a policy, you're left vulnerable. You have to go out and buy your own insurance. That's great if you're healthy and you can go out and get it. Or let's say you're starting your own practice, but if you're not healthy, it can be a problem. You may not be able to go out and get it on your own. So you might say, oh, fine, I'll stay here so I can keep my benefits, which may not be ideal.
Kind of like the health insurance situation for a lot of people that have health insurance through their employer and will be left high and dry if they leave. Yeah, the great American system. Okay, so you talked about the tax implications. So basically, if the group's paying for it, they're paying for it with pre-tax money. So if you get it, you've got to pay taxes on it. If paying for it with post-tax money, so that you've already paid the taxes, so then you no longer have to pay other taxes on it, right?
That's exactly right. Yeah.
Okay.
And so if you do have an individual policy, you always want to pay for it with after-tax dollars out of a personal account, so the benefits are tax-free.
Okay, so are there any strategies for optimizing tax efficiency, or like this is just how it is and there's no way around it?
That's really the way it is, especially if you work at a large hospital or university setting. There's really no way around it. Now, most people still supplement a group policy with their own individual policy for several reasons. One is that portability piece. So if you have your own individual policy, that goes with you. So if you ever leave your group, that policy can go with you and you can increase it or decrease it or expand it. So you have your own coverage. Number two, if you go on claim, the individual policy always pays first and foremost. There's no offset. An individual policy will not say, oh, you have something through the group, we're going to pay you less. Some group policies might say, oh, you have some individual, we're going to pay less. So it depends on the group. So the individual policy is always going to pay first. Third, the individual policy typically is also what's called own occupation. So it's going to cover you if you can't work in your specialty. You don't have to be totally disabled. So that's the reason most people carry some level of individual coverage to bridge the gap between what the group policy is providing and what you need to be able to sustain yourself.
So you mentioned health status. You mentioned somebody's health status affecting their premiums. So how does your health status affect it? Because it would seem to me like if you've got a health issue, then they would just put that as an exclusion. And if you have something related to this pre-existing condition, we're not going to cover it. Versus it could be covered, but your premiums have to be much higher. Like, how does that work?
You buy an individual policy, they will ask you medical history, head to toe, last 10 years.
Yeah.
If you've had some medical conditions, chances are they're going to exclude it. So you had knee surgery, you had back surgery, something like that, they will typically exclude it. The only time they add additional premium is if you have pretty significant history, where it's something that maybe it can't be excluded, or we'll give you a policy, but we're going to charge you extra. That happens pretty rarely. Typically, they either say, yes, we can offer a policy, no, we can't, or we're excluding something specific.
Yeah. Okay. So if you've got like a bunch of medical problems that could then lead to other problems, right? Like we're talking about like a severe autoimmune disease or diabetes.
You're
and
type
high
1
blood pressure and
diabetic
high
or something.
cholesterol.
Yeah, it can make it really
Yeah.
tough. Yeah.
Yeah. Okay. All right. So it'll be excluded, but for a lot of things, like you needed a knee replacement, that would be excluded, but it wouldn't make your premiums higher.
That's correct. Now, if you do get a policy and they put an exclusion on the policy, it's really important to ask them if they'll ever reconsider it. So
Yeah.
like you mentioned knee surgery. So I have clients, they get a policy, they had knee surgery last year, they'll exclude that. We always ask, when can that be reconsidered? Sometimes they'll say, once you've been treatment free for 3 years, 4 years, 5 years. And
Yeah.
at that time, assuming you've had no problems, you can request for them to remove that exclusion. So that's really important too. So once that's removed, that's covered.
Yeah. Okay. How do we figure out how much we need? Because it seems like there's some conflicting information here. You're saying anything that's contradicting yourself, but like you need a certain amount of income. You've already got a group policy, right? So then you don't need enough to completely replace your income because you already have a group policy. However, if you leave your current job, now it does need to replace your total income, or is it
So there's
fluid
only
enough
a
that we can
maximum
approach
amount
things
you can actually purchase. So there's something called income and participation limits. So during residency, you can automatically get $5,000 a month benefit regardless of income. Once you're out of residency, they will only allow you to get a certain amount based on your income. So typically you can replace about 60 to 70% of your gross income, or about 80% of your after-tax income. So when you apply for a policy, they'll say, okay, you're making $300,000. You have this group policy that covers you up to $10,000 a month. We'll let you supplement with X amount. So there's only a maximum amount you can get. So you can never overinsure. You can never say, oh, I need $15,000 a month, but your take-home pay is $10,000 a month, because if you go on claim, you're not as incentivized to try to at least go back to work. So there's only a maximum amount you can get. But the answer to your question really depends on how much you need to have. So some people need as much as they can get. They're the breadwinner, or they live on to the full extent of their income. They have a lot of expenses. They want the maximum amount. Some people live way below their means, and maybe they're single and they don't have a lot of expenses. They don't have loans. So they only get a smaller amount to cover whatever their take-home pay is.
Yeah. All right. That makes a lot of sense. All right. Is there anything else that you would want a mid-career physician to know about regarding disability insurance or life insurance that we haven't spoken about yet? Like where to find the holes that need to be plugged?
I think when you're in your mid-career, you also need to assess your overall financial situation, because it can start to become more expensive to get disability insurance if you are mid-career, because policies are based on your age and sometimes your health. And so I think you really need to prioritize how much you need to have. And maybe there's some riders you can forgo. Maybe you don't need the inflation rider. Maybe you can wait 180 days till the benefits kick in. So maybe there's some movement in there on how to set up the policy to try to keep that premium down while still taking care of your needs. So it's a little bit different than when you get your policy early on, where you have a lot of vulnerability and it's not as expensive. So you want to look at that overall situation, and you do want to look at the household. So if something happens, maybe there are 2 people earning an income. Maybe you don't need to both insure to the full amount. Maybe you take a look at that and say, okay, maybe we each need to cover some of it to be able to balance out the cost of it. So that's something to keep in mind. In terms of the life insurance in the mid-career, again, rule of thumb is you need about 10 to 12 times your income to replace your income if something happens to you. And you want to have that insurance in force until you've either accumulated enough assets to self-insure, or like I said, till the kids are up and out. So if you have a 5-year-old, a 6 and an 8-year-old or something like that, you probably would be fine with a 20-year term till that kid's 25 and about 10 times your income. Rule of thumb. Again, depends on your situation, depends on your assets and your debt and all of that. But that's just approximately what you'd be looking at.
That makes a lot of sense, especially what you said about finding some riders that you wouldn't necessarily need, right? If it's more expensive to have a policy that's going to kick in 90 days after your injury than 180 days, you're basically self-insuring for that 90 days. And if you're mid-career, hopefully you've got enough in savings that you can handle that before the disability kicks in which case then you don't have to pay, because it's ultimately, this is gambling. Like, you're paying for someone else to take this risk for you because you can't afford to do it. You're pooling risk with your colleagues, and the disability insurance company is there to facilitate that pooling of the risk. And so if you can handle more risk because you have enough in savings, then you should, because your premiums will be lower accordingly. And that you can foot yourself, you should.
Exactly. And some of it also depends on how much debt you still have. Maybe you've paid off your loans. Maybe you don't have a mortgage anymore. It just really depends on your overall situation. Yeah. But I do think mid-career, you do want to assess your overall financial well-being and really prioritize what's most important. So you're not overspending on the insurance either.
Yeah. Excellent advice. So if people want to learn more, if they're like, okay, I am not in the safe financial situation that I thought I was, after listening to this, I definitely need more robust individual policy, or at least I'd like someone who knows what they're doing to take a look at my policies to find out if I'm in a secure place financially. Where do we find you, and where do we learn more?
So the best way is just to go to our website, setforlifeinsurance.com. You can request a quote. There's also a lot of information on there. And like you mentioned, a lot of people come to me and say, I bought this policy 10, 15 years ago. Is it still a good policy? Is it still covering my needs? Do I need to make any changes on that? I'm always happy to review that. And one other thing I did want to mention is we work as independent brokers, which means I don't work for any particular insurance company. So I don't have a bias where this is the best policy, this is the only policy available. I will shop it around. So what I might recommend for you might be totally different than somebody with different criteria. And so it really makes sense to be able to shop it around to make sure, again, you're not overspending. Maybe you have all the discounts available, you have all the appropriate things on your policy, and it's set up properly.
Fantastic. Jamie Fleischner, thank you so much for your time and all you do for physicians.
Thank you so much for having me. I really appreciate it.
Hey, this is Brad Block, host of The Physician's Guide to Doctoring. This is a personal and professional development podcast for physicians where we have experts on the show that try to teach us everything we should have been learning while we were memorizing Krebs cycle.